been to other educational series in the past. So maybe you have joined us for other programs as part of our educational series, but I think it's a good opportunity to kind of hear what else maybe you have enjoyed and participated in. So thank you for doing that. So I am going to be introducing our moderator today, and she's going to be facilitating the program, introducing our speakers, Sophie Gilbert, and then also handling questions at the end of the program. So we have a wonderful volunteer, Meg Prestigiacomo, who's been volunteering with the foundation for a number of years. She's a vice president and financial advisor at Prestigiacomo Carroll Group, which is part of Baird. And she's been a great volunteer on our donor development committee and has a lot of experience in estate planning and planned giving, and has really helped us organize a number of our educational programs. So it is my great pleasure to introduce Meg, who's going to moderate today's program.
Thanks, Jenny. Hi, my name is Meg Prestigiacomo, and I'm very happy to be here today presenting our speaker for today's event. As Jenny mentioned, I'm a financial advisor, and I've been in the industry for over 20 years. In fact, I started over 20 years ago with the intent of helping women to become more engaged and more informed in their finances. So today's topic, women and wealth, is very personal to me. One of the things that I have found with women is that we have made great strides with regard to attaining higher education degrees, starting businesses, but that we still are behind when it comes to planning for our own financial futures. In fact, over 90% of all women will either become divorced, become widowed, lose a spouse or partner, or remain single. So what that means is that if you're not already managing your finances, at some point you likely will be. Our circumstances are a little bit different. As you know, we tend to live longer. We tend to make on average less than men, and we are really good at taking care of others. So Sophie's going to talk today a little bit about how we can take better care of ourselves financially and how we can plan for our own futures. Before I introduce Sophie, I wanted to go through a couple of housekeeping items. Sophie's presentation will be about 30 minutes, and during the presentation, if you have any questions, please feel free to enter them in the Q&A box, and I will do my best to get all of those questions answered at the end of her presentation. I'm very pleased to have Sophie Gilbert here today from Russell Investments. Russell Investments is a firm that we at Baird have used for many years, and they've been a wonderful partner for us and for our clients. Sophie Gilbert heads up Russell Investments portfolio and business consulting teams, the teams that support advisors to help grow their businesses. She's been with Russell for over 10 years. She's been working with advisors from across the world, including the UK, Switzerland, Germany, Hong Kong, Singapore, Canada, and the US for over 20 years. She was born and raised in Berlin, Germany, and now lives in Seattle with her 3 boys. She speaks French and German fluently, but she said she would stick to English today for all of you today. So with that, I'd like to introduce Sophie Gilbert.
Terrific. Thank you so much. Thank you, Meg, and thank you, Jenny, for having me here today. It's an honor to be here and to be able to join you in this afternoon setting and getting a chance to talk about a topic that is near and dear to my heart, and as we can hear from Jenny and from Meg, also close to their hearts, and likely the rest of our hearts, everybody that is joined here today. So thank you for taking time out of what is likely to be a busy time of day and of year for you, a year that has been unlike so many others in the past, and so many different curveballs being thrown at us. So it's wonderful that we're taking the time here today to be together and to really think about what can we do to help secure our financial futures in the future, especially when there's so many unknowns, especially at the moment. Now, this topic is near and dear to my heart also because talking about it reminds me a little bit of the setting that I had when I was in college. I went to an all-women's college, and so normally when I do this presentation, I get to meet in person with women and groups of women, and it reminds me of being in college, of being in one of those senior seminars at Smith College and getting to be in a setting of just women and being able to share ideas and share what is really top of mind and sort of near and dear to our hearts at the moment, and sort of have that vulnerable and open conversation. In the rest of my life, as Meg mentioned, I'm surrounded by boys, my 3 boys at home, and also men. Finance is a very male-dominated industry, and so this presentation and the predominantly female settings that I get to be part of are really unique and special to me. I hope this presentation will be special for you as well today, and we'll be able to see, how can you potentially change your course and be able to influence what your outcomes and what you want them to be in the future. So with that, we're going to go ahead and get started with the presentation. We're going to look at a few different aspects here. First, we're going to look at the health implications or the wealth implications of better wealth, right? As Meg mentioned, we do live longer than men typically do, and that can have implications for our wealth on an ongoing basis. Then we'll look at how women actually make naturally very strong investors. We have very good intuition, even if we don't always feel very confident about financial decisions that we might be having to make. We actually have very good intuition about finances and about money and about investing. So channeling into those and into that confidence can help us a lot. And then lastly, we'll take a look at what is it that you might be able to consider doing for yourself and for other women in your community, in your circle of friends, within your family potentially, to help give them that confidence as well for a better financial future. So with that, let's go ahead and get started. Now, the wealth implications of better health, we have all done a very good job of eating our kale and exercising and, leading very healthy lifestyles. I think there's no time like the present where we have all reevaluated what are the health choices that I'm making and what are the impact and the implications for my life of those health choices. So being able to realize that those have implications, that our health choices do have implications on broader life spectrums is really important. Now, a lot of those health choices that we've made have led to us living longer. Now, if I was to ask you, how long do you think, or at what point in U.S. society do you think that there are more men or more women than men? At what age do you think that happens? I imagine that many of you might be thinking, well, maybe around the age of 70 or 80, there suddenly are more women in society than men, especially knowing that actually, when you look at the census data, there are more boys born in the US than women. So at some point, there is a bit of a tipping point, though, where suddenly there are more women. Now, you wouldn't be alone if you're thinking that tipping point happens around the age of 70 or 80. In actual fact, it happens much earlier than that. So here you can see this on the chart here, where we can see that around the age of 34 is actually when that transition happens. That's when suddenly we begin to see that there are more women in society than men. Now, there are a lot of factors that contribute to that, but the point is suddenly that happens much earlier than we think that it actually does. Women really do outlive men, and they outlive men at an increasing amount as they age, such that by the age of about 80, when you look at the cohort of 80-year-olds in U.S. society, 64% of those are women. Now, living longer is not the only thing that sets us apart from men. There are other factors as well, but at the same time, there are some things where we have become more similar to men. And those, for instance, are education, vocation, sort of being able to choose our professions, and also marital status, having a choice around the marital status that we would like to have and would like to be able to pursue, whether that's getting married or getting divorced or staying single. We have a lot more options now as women. Speaking of education, women are actually more educated than men now. More than half of PhD degrees and advanced degrees in the US are earned by women now. And that's been the case for a few decades now. That's not just a recent phenomenon. That's been the case for a while. In terms of vocations, obviously there are many, many professions that women are now, fully fledged part of, aren't just deputies, but are actually, sort of bona fide participants or leaders in organizations and in different parts of the economy. In fact, there's one statistic that, that demonstrates how women are really great at founding companies and at growing companies. In fact, if US-based businesses were their own country, they would have the 5th largest GDP in the world. At the moment, the 5th largest GDP in the world is held by the state of California. So imagine that. The power of women in the economy can be as large as the state of California and the 5th largest GDP of the world. So really, women are an economic force to be reckoned with. We make a lot of the purchasing decisions in our families and in our homes, and we are part of the professional fabric. I mentioned that I have 3 little boys. They're 12, 10, and 5. And my 5-year-old is going through one of these Lego phases at the moment and has recently received a very coveted Lego fire truck set that he had been eyeing for a while. And he was ecstatic when it arrived, of course, and very excited about it. I was too, and not for exactly the same reasons as Noah was. He was excited about the big truck. I was really excited about the little figurines, the little Lego figurines that came with the truck. One of them, it came with like 3 or 4 of them. One of them was a female firefighter. Now, she did have mascara on, which I thought was a little bit odd. I'm not sure that female firefighters make that one of their priorities when they're out fighting fires. But at the same time, I was really impressed to see that even in a toy set like that, now it has become common enough for there to be female firefighters that it would show up in a toy set as well. So that was really encouraging to see. Now, at the same time, women and men are still different, right? There is still this best-selling book out there about men are from Mars and women are from Venus. And we can think what we want about it, but there are still some differences between men and women. One of them is around priorities, and certainly when it comes to wealth and to family priorities. And here the research shows that women and men really do have different priorities. This was some research done back a few years ago, where the researchers asked men and women independently to rank prioritize among 17 items what was most important to them. And as you can see here, men said that spending quality time with family and being financially prepared were the 2 most important things to them. Having balance in life and being a good parent sort of came as more distant priorities. On the flip side, for women, you can see here represented in blue, spending quality time with family was extremely important to them, and being financially prepared was one of the last things that came on their list. Having balance and being a good parent were more important to them. Now, I wouldn't want us to interpret from this that men don't care about being a good parent and that women don't care about financial security. I think instead what we can infer from this research and take away from it is simply that men and women do have different priorities, and it can have implications for them. Now, I have to admit, when I first saw this research, I read it at the office, and I thought, oh, well, this is interesting. This is helpful to see, and I guess I'm glad that I work in the financial profession, and so I do, pay a lot of attention to financial security, and I give talks about financial security and about investing and about saving for retirement day in and day out to investors. And so this is helpful research, but I don't really see it applying in my own life, and I felt some relief at that. Well, as you can imagine, I went home that evening, and did I get a lesson? I was sitting in our home office that we have at home, and we have a whiteboard that's just off screen. You can't see it here, but we have a whiteboard where we track our to-dos of what are the things that we need to be doing on a personal level. And I realized in looking at that whiteboard, I looked at it differently suddenly after having read this research. And I realized that my items on the list all related to the family and to the children. So at the time we had a toddler, and so I apparently had to, buy a new car seat, which involved doing some research and figuring out. He was our first child at the time, and so I didn't know much about car seats. So I had on there, you know, figure out how to buy a new car seat, and I was going to apply for preschool for him. And I also wanted to make sure that I didn't forget to write thank you cards for the birthday party we had recently had for him. My husband's item on the list, the one item on the list, now one versus multiple is a subject for a different presentation, but in this case here, the one item that he had on the list was to schedule an appointment with Peter. Peter is our financial advisor in Minneapolis. Now, that was insightful for me, right? Suddenly, I was realizing, wow, we have different priorities here. He is the one who is focusing on financial preparedness, even though I work in the industry, and I have all of the items that are on there related to our family. That was really curious to me and eye-opening to me. So having different priorities is something that really does still pervade us, and it's just something we need to be aware of. We also need to be aware that even when we are investing and when we are thinking about our finances, women tend to be more risk aware. So some people say that we are more risk averse. We're less likely to invest in, say, stocks or into portfolios that are more aggressive, where we might lose more money, might make more, but we might also lose more. Women tend to be more risk averse in that way. I like to think of it not so much as risk aversion as opposed to risk awareness. I think that actually the way that women look at risk is more wholesome and more holistic. We think more about trade-offs. We think more about opportunity costs of, if I invest here, then what are my options and what are the risks here? And we look at it from a holistic perspective of what are the implications for the other parts of my life as well, right? A little bit like the wealth implications of health. We begin to realize we're going to live longer, we need that money to last longer, so how do we need to invest? We think about things in a much larger context, or we think about, if I'm going to invest in this portfolio, how might that benefit my children? How might that benefit my community? How might that be able to benefit or change my options in terms of my lifestyle? We think of risk holistically like that, as opposed to simply thinking about it as, I'm going to make more money or I might lose more money in relation to certain investment options. So there's that aspect to think about as well, is that risk tolerance and that approach to risk. Now, at the same time, all of this actually reminds me of my grandfather, who was an ambassador. So he was in politics and was very, sort of very successful in his career. At the same time, he had 4 very strong-willed daughters at home and a very strong-willed wife. And so at home, at the home setting, he knew where his place in the universe was. Now, he really wanted to make sure that I was financially secure, and really impressed upon me the following lesson if we take 2 hypothetical investors, we can call them George and Anna. They are not related to each other, but they're both about 65 years old and have accumulated a nest egg of about $1 million and are ready to retire. They've earned their retirement. They're looking forward to being able to retire, each independently. Now, how much might they have in income in retirement, each of them? Now, George, being 65 years old, having about $1 million nest egg, if you make some assumptions about his risk tolerance and about how the markets might perform and his tax status, you can assume that he'll have approximately $7,000 in retirement every month. Now, depending on where you are in the country, that's a pretty good income on a monthly basis. Now, what might the situation look like for Anna, for our 65-year-old female? What might she be facing, and what might her options be in retirement? Well, there's a few different factors that we want to take into account for Anna. Now, Anna, because she's 65 years old, based on current statistics, we can expect that she'll probably live about 5 years longer than George will. And so she's going to have to make sure that that $1 million nest egg that she's accumulated lasts for that extra 5-year time frame for her. So how much might she have in retirement? Well, she'll probably have about $6,455 left in retirement per month. Again, not so bad. Now, at the same time, Anna might have taken some time out of her career while she was, raising a family or taking care of family, or maybe she wanted to dedicate herself to a passion that she had during her career. So she maybe took some time out of her career. Now, also, while she was working, most likely she was making less than her male peers were. And so maybe she didn't actually make it to that $1 million nest egg. Maybe she only made it to a $750,000 nest egg. Now, suddenly she's having to draw income in retirement from a smaller nest egg. How much income might she have in that situation? Well, about $4,500 per month. And then lastly, maybe Anna, like many of our other, female cohort, maybe she was a little bit more risk aware or risk averse than George was. And so maybe her portfolio wasn't invested quite as aggressively and in as many stocks as George's was. And so maybe her return is a little bit lower and her portfolio and her nest egg are a little bit smaller. How much might she have in retirement at that point? Oh, about $3,600 per month. So now suddenly we begin to reflect on this and see that simply by being born as Anna instead of as George, Anna is having to live off of only about half of the amount per month in income during retirement as compared to George. Now, that doesn't seem fair, right? This is where my grandfather comes back into the story. As I mentioned, he was very successful. And when I was visiting him a few years ago, I snuck into his study because I had noticed earlier in the day that he had a very curious looking book on his desk that was called Everything Men Know About Women. And it was a very dog-eared book. And I figured, gosh, he knows a lot about women, having spent his life surrounded by women. I'm really curious what he found interesting in this book and why it's so dog-eared. Which are the most dog-eared pages? What does he know about women that I don't know about women? And what do other men know about women that we don't know? And so I snuck into his study when he wasn't there and started leafing through the book and paging through it. And suddenly I realized that every single page in the book was blank. The whole thing was a prank. Now, my grandfather hadn't missed a beat. He had seen me sneak into the study, and he was standing behind me. And when he realized that it had dawned on me what this book was about, he said, well, Sophie, what did you expect? What did you expect to find in this book? So to me, it was sort of a wake-up call in that lesson again, that we need to be at the table when these decisions and when these conversations are happening, because nobody knows us as well as we know ourselves. And we need to have a voice. We need to know what is it that we want to accomplish and make sure that our positions and our priorities are being reflected in the plans that we're building. Now, that's even more important because, as Meg mentioned in her introduction, at some point in our lives, 90% of women will be solely responsible for their finances. And as Meg said, whether that's because we've chosen to remain single or because we've gotten a divorce or maybe we've lost our spouse, at some point we will be solely responsible for our finances, or the chances are high. Now that's for 90% of women. I would like us to try and achieve that 100% of all women feel confident if we get into that situation. And whether we're in that situation or not, we surely know other people that are, that we can help support and be there for, so that they don't feel so alone, and so that we can help bolster their confidence in those situations. Now, luckily, we as women make really, really great investors. We have really good intuition, a really good sense for making good and sound money decisions and investment decisions. This has been recorded by the media and by researchers all over the world and tends to hold true. Now, at the same time, the market is not for the faint of heart, and it's not gender neutral either. There are some activities and behaviors that investors around the world, whether men or women, can easily fall prey to. There's a lot of neuroscientists that have been doing research, and economists and psychologists, to really try and understand, how do we as humans make money decisions, and what are some of the biases, what are some of the traps that we fall into that cause us to sometimes jeopardize the health of our wealth simply because we've made poor decisions. Now, we can see here that oftentimes when there is market volatility, when the markets are going up and when they're going down, suddenly we end up buying into or buying out of the stock market at exactly the wrong times. Here you can see the orange lines here represent investors moving into and out of the market. If the orange line is above that black horizontal line, it means that investors are on net investing in the stock market. When the orange lines are below that horizontal line, we're on net, where most of us are pulling money out of the market. Now, the blue line represents what the U.S. stock market is doing during that time. And as we can see, during the tech bubble or the credit crisis, during those periods where there was market volatility, investors were pulling money out of the stock market. And that's sort of driven by emotions, right? Money and investing can be very, very emotional for all of us humans. We go through this roller coaster where when our portfolio is doing well, we feel excited and we feel thrilled. At some point, we might even feel euphoric. And often that's the point where we want to invest more and we feel confident about the decisions we've made and about the outcome. At the same time, as markets begin to wobble and maybe our portfolio loses in value, we begin to feel fearful and panicked and sort of anxious about things. At some point, we might hit a point of despondency where we simply want to sell and we just want to get out of the market. We want to participate in that orange bar that is going down below the zero line and just want to get out of the market. Now, of course, if we're working with an advisor or if we have an ability to pause and to think and stay calm and carry on, we actually realize that our intuition is exactly wrong and is the opposite of what we should be doing. Those points of euphoria where we feel extremely confident actually should be points where we begin to feel a little bit overconfident, and we should be careful and actually not be investing then, and certainly not doubling down on our trades. And instead, we should pause, because that can be the point of maximum financial risk, where we risk buying high and ultimately selling low. Instead, or similarly, those points of despondency where we just want to get out of the market, we can't stomach it anymore, and we can't take it anymore, are actually oftentimes our points of maximum financial opportunity, where we have the chance to invest in basement bargain prices in investments that were much more expensive before, and that maybe have a better opportunity for picking up in value again. Now, unfortunately, all of these emotions are gender neutral, and they also cost investors money. If you look at the sort of average investor that succumbs to this emotional roller coaster and acts on that emotional roller coaster, we can see that they give up almost 2% or just above 2% in return every single year in this time period between 1984 to the end of 2019. That's if you compare the average investor's return of about 8.8% relative to the return of the US stock market at about 11% per year during that time. Now, 2% might not sound like a lot, but ultimately compounded and taken year after year after year, that can end up representing quite a lot of money. Now, luckily for us women, we tend to be pretty in tune with our emotions, and we tend to have an approach to making decisions, whether they be financial decisions or other decisions, that is actually really quite well honed and allows us to be pretty rational on whole. Now, researchers have been doing, as I mentioned, a lot of research into brains of humans and brains of men and women to see how are they different and how do they differentiate from one from the other, and what are the implications for investment strategies during that in applying those approaches. And they found that female brains and the way that we approach decision making is actually quite similar to the way Warren Buffett makes decisions. Warren Buffett, of course, being the amazing investor from Omaha, Nebraska, who has made a tremendous amount of money on behalf of his shareholders and his clients simply by being very thorough and methodical. So for instance, what are some of the ways and his strategies that Warren Buffett adopts for making decisions? Well, typically when he's making an investment decision, he takes a very long-term approach. He does his research, and he ends up having to trade less often because he makes good decisions. So for instance, in terms of taking a long-term view, he wants to look at an investment and say, I want to hold this. I want to be able to hold this company until, in perpetuity, like forever. I don't want to have to sell it. And so he is very conscious about doing very in-detailed research, where he talks to the management of the company, he talks to the creditors of the company, he talks to the shareholders of the company, he talks to multiple ranks of management in the company, he talks to the clients of the company, really to get a very holistic picture of the potential investment he's about to make, because he doesn't want to just make a quick buck. He wants to invest in the long term. So he does his research very thoroughly, and then ultimately ends up having to trade less because, and chooses to trade less because he's making these long-term decisions. Now, when I first looked at this list of sort of approaches, I realized that this is very akin to how we women often make decisions. So for instance, if I think about my Amazon purchasing history, I imagine there are others of you with us today who have maybe an Amazon habit. My husband likes to call it an addiction. But in our family, we have a rule that if Amazon doesn't sell it, you don't need it. I try to justify my Amazon purchasing by pointing out that Amazon is actually, their global headquarters is here in Seattle. And so my Amazon purchasing is actually supporting the local economy. I'm shopping locally. My husband doesn't buy that. But if I look at my Amazon purchasing history, what I realize is that I do my research on there, right? It's a fantastic research platform. It helps me be able to see, am I getting a good deal or not? All of those reviews that people have entered into Amazon, the reviews, the 5-star reviews, the 1-star reviews, the long ones, the short ones, the old ones, the new ones, I definitely read them. I am very grateful to people who put in reviews. If I think back to when I was having to buy that car seat for my toddler, I absolutely read those reviews because I didn't know what I was getting myself into, but my peeps on Amazon definitely had me covered there. So again, we tend to do research, right? When we move to a new location and we're looking for those pediatricians, for those doctors, for the best dentist in town, what do? We don't just open the yellow pages. We reach out to contacts. We get their feedback. We get their testimonials to be able to help us make a much more informed decision so that we can feel confident about our decision and don't have to make a change. So this is really how we tend to just make decisions, and it definitely helps us. And it's ingrained into our brain. So it's not something that we need to learn. We just need to listen to that voice and allow it to be able to make those decisions and allow us to guide us in those decisions. Now, when it comes to our portfolios, this type of approach to decision making actually really sets us apart and helps us a lot. Men tend to trade much more frequently than women do, and that ends up costing them in return to the tune of almost 2% per year, where they are giving up that return because trading costs money and because it costs in taxes and because they're not always timing the market well and right. We saw this certainly in the last financial crisis, where the researchers went and pored over trading logs of investors and saw that men had a much higher tendency than women to sell out at the bottom of the market. So exactly at that time where, yes, our gut instinct might be telling us, or our emotions might be telling us to sell out, but we know rationally that if we can pause and we can think about it, that's not actually the right time to sell out. Men were much more likely to succumb to that emotion than women were. Now, women like to point out, well, at the bottom of the financial crisis, as in, during the pandemic, I'm way too busy to be focusing on my portfolio. I'm way too busy to be thinking about, should I be trading right now or not? I'm focusing on my kids and on my family and on my job and on everything else that's going on my community and helping. I don't have time to be thinking about my investments. That's why I'm not trading. And maybe that's a good thing. Now, at the same time, what can we do to make sure that we stay ahead of the curve and that we do give ourselves time and space to intentionally make good investment decisions and make those investment decisions with intentionality? So here, we can all have good intentions, but how can we make sure that we're actually acting on them? So I wanted to suggest a few different areas where we might be able to get started, whether it's for ourselves and maybe also sort of striking up a dialogue with others, or even amongst ourselves today after this event, where you can start a conversation with others about women and about women and investing. So the first thing for us individually is to make sure that we're organized, that we know where is our money, how much is it worth, and how do I access it. Next, we want to think about, I want to know where I want my money to take me, right? Money is just a tool. It's a very important tool and it's a very valuable tool, but we are in the driver's seat and we need to tell it where we want it to go and not losing sight of that. And then, of course, we want to be investing, and we want to invest in a way that is commensurate with our own risk tolerance and also with our own risk awareness. And then lastly, I would encourage us to strike up a conversation, right? We have this taboo, especially among women. We have a taboo around talking about money. And I think that oftentimes that doesn't actually serve us very well, because we can learn a lot from each other in the same way that we learn from each other about who are the best dentists and who are the best pediatricians and what is the best restaurant and who is the best gardener. We can all learn from each other also about money. Now, we don't have to go it all alone. We can get help from a financial advisor as well as from other members of the community to be able to help get us started on this. Now, in terms of the getting organized, here are some ideas for folders, whether they be on our computers virtually, or whether we want to have them as physical sort of manila envelopes. But here are some areas that we want to make sure that we have clarity on in terms of our organization. Again, that thought of where is my money, how much is it worth, and how can I access it? And also remembering that, money is just a tool, right? We need to know where we want it to take us. So thinking about that again. I think that oftentimes here, I think about the cautionary note that flight attendants tell us back in the days when we used to be able to get onto airplanes and fly, where they tell us about about the oxygen mask, right? And they say, now make sure that you put on your oxygen mask first before helping other passengers with theirs. Now, next time you fly, maybe take a look and watch the flight attendant carefully. Watch, where are they looking? Who are they looking at when they say that? And you'll notice that invariably the flight attendant is looking at the women in the first rows of the airplane in front of them, because they know that women are the ones more than men who need that reminder of make sure that you're also focusing on yourself and not just on everybody else. Now, when it comes to investing, we want to make sure that we are giving ourselves that time and that space to be able to think and to dream and sort of explore, what are my priorities? What do I want to be able to accomplish? What are my dreams? And how do I sort of organize myself and my money and everything else around that so that I can also accomplish my goals? Part of that is investing and taking appropriate financial risk. So making sure that even if we can only put away a little bit of money and put that to work in a portfolio, that's already a little bit more that can grow into a lot more. Just a little bit every month or every year can go a long ways, much longer than we think. If we have younger people in our communities, encouraging them to start early can really, really make a difference and set them up for success in the long run. And then the taboos. We have a lot of taboos in society around what we do and we don't talk about with others. Money tends to be one of those taboo topics. Let's change that. Let's talk, let's be honest, let's be vulnerable, let's learn from each other's money mistakes and also from each other's money successes, right? We don't have to talk in exact dollar terms. We can still, keep things private that need to remain private. But I think that sharing those experiences can make it feel less scary and can help give us all more confidence and feel more like we're part of a community. Where might we want to start those conversations? We have some lists of questions that you might want to consider depending on what age cohort you're in. There's different financial issues that might be more top of mind for you and might be, more relevant and more important for you. But ultimately, making sure that you are surrounded, that you surround yourself with people that can help you, that can support you, that can help you think through the different parameters, that can be your advocate. Whether that's a financial advisor, I mentioned I work with an advisor, and it has been a tremendous relationship that even though I work in this industry, it's very, very helpful to have an advisor as a sounding board, as somebody who is thinking about my money while I'm busy earning it. And I'm busy having my life and raising my children and doing other things and being able to give back to my community, knowing that I don't also need to be thinking about, am I putting my money to work in the best way possible, has been a real sort of relief for me. And I hope that it can be a relief for you as well. Now, with that, I want to thank you. And I want to thank you for having taken time out of your busy day, for having put on your oxygen mask, for having prioritized yourself today and other people that are important to you and your family, to take that time to think about, what is it that I want to do? What is it that I want to accomplish? What might my next step be? How might I be able to fulfill my dreams in the future? And what might that future look like for others that I can help enable as well? So with that, I want to remind you that our brain is hardwired for really, really great investment decisions. So put it to work for yourself. Thank you. With that, Meg, I'll turn it back over to you.
Thank you very much, Sophie. That was a wonderful presentation. And I have to say that I think one of the best pieces of advice in there is encouraging women to talk about money. You are so correct in that we all think it's very taboo to talk about money. I think we as women are very apt to talk about so many other things in our life, whether it's shopping or what we're doing on the weekend or our travel. But when it comes to money, we don't often talk about it. And I will tell you that I think one of the biggest questions that I get from women is, am I saving enough? And so that's a really great example of, how much should I be saving for retirement? And there's nothing wrong with talking about subjects like that. I would also say that one of the things that we encourage our clients to do is to talk to their parents about their finances, because I think we can learn a lot about how our parents have managed their finances. And as you know, it's also been taboo for parents to talk to their kids about it. So let's start by having that conversation. It doesn't have to go into great detail, but I think having those conversations is very important. So with that, I'm gonna have a few questions for you. And I'll just preface this, Sophie, that if you can't answer it, or if you want me to answer it, I'm happy to do so. So I've got a couple specific questions. The first one is, at age 72, 80% of my investments are in entities which require RMDs, required minimum distributions. So I would assume that's all of their assets are in IRAs. Given I don't need these funds to cover living expenses, does it make sense that I withdraw money above the yearly RMD, pay the taxes on the same, and reinvest the remainder, as long as it does not push me into a higher tax bracket? So again, I'm happy to answer that question, but if you want to take a stab at it, go ahead.
Yeah, I'll answer at a high level. The high level being, it's great that you know this much about your finances. So congratulations. That's really great and shows a great amount of engagement and commitment to your financial security. So that is fantastic. Congratulations. And congratulations that you have required minimum distributions that you might not actually need all of those proceeds from. That's really impressive as well, and shows that you've really built up a meaningful nest egg. I will say that I can't answer specifically here because I don't know the rest of your situation. I think that your intuition of thinking about taxes makes a lot of sense. And I know that there are a lot of sort of tax advantaged and tax aware investment opportunities out there for taxable dollars specifically. So I would encourage you to explore those, but more importantly, I would encourage you to speak with a financial advisor who would be able to look at your portfolio overall and be able to look at that in the context of your goals and your circumstances and your preferences, and make sure that they're advising you specifically as opposed to sort of more generic advice. I don't know, Meg, what you would want to add to that.
Yeah, I can get into a little bit more specifics. So this year we did have the CARES Act that passed earlier this year, and that allowed individuals to be able to waive their RMD for 2020. So I'm not sure if this person already knows this, but you do not have to take your required minimum distribution from your IRA in 2020. That begs the question, should I still take it? And it sounds like from your question, you do not need the money from the IRA. Then it comes down to taxes. So if I would say most of us would say if you do not need the money, then leave it in the IRA and continue to have it growing tax deferred, and then you would pick up your RMD starting next year. I have seen some CPAs when you're doing tax planning, and so if you're in a different bracket from one year to the next, if you're in a very low bracket, maybe this year, and you anticipate being in a higher bracket next year, you may wish to take your RMD. So it does come down to some tax planning, and I think that's where working with a financial advisor and your tax advisor would really be able to give you some specific advice for your situation. I do have one question about, can I get a copy of the page that tells what financial information to organize? So Sophie, are you able to send out the presentation? Yes. Okay.
Yeah,
okay.
I absolutely can. I'll get it to Tracy and to Jenny, and I'm sure they can help circulate it. Yep.
Another question. I'm not very good with numbers. My husband manages all of our finances. Where should I go to educate myself?
So I think there's a number of resources online that can help. I think, in terms of learning some basics, there's some good books out there. I can share, some topics. I'm sure that the Madison Public Library would be very happy to share some advice as well, and has some great books on the shelf that you can use as well. Again, I would hear a financial advisor is very, very valuable in terms of educating as well. Again, I'm in the industry, I have an advisor, and even with him, we sometimes have conversations, because even for me, when I think about this for other people, it suddenly feels different when it's about me. And so I'm like, okay, wait, let's go back to basics again. How does this work? And how does this work in my situation? So I think there, being able to partner with an advisor that you trust can be really helpful, even on the educational side, or especially on the educational side, and help you really identify, what do I really need to go to school on and know a lot about, and what is not so relevant for me, or what do I not need to worry about so much? Because I know that initially it can sort of feel very overwhelming and feel like numbers are not my thing, and now I need to understand all of it. We don't need to understand all of it. We can get help and support from other people in other areas, and also not all of it is relevant to each of us. Meg, what would you add?
Yeah, I would say that I think I get this question a lot, this comment a lot from women clients, and that they would say that, again, they're not good with numbers. And, I always say you're more of a natural when it comes to financial planning. We're very good at multitasking. And so when it comes to planning for investments, that does not mean we're planning for our future. That does not mean that you have to follow the market every day, or you have to know how to pick stocks. And I think that's what we saw in the late 1990s when the stock clubs were all the fad in late 1990s, and everyone wanted to join one because we all wanted to learn about how we can pick stocks. And I spoke at several of those clubs. But what we found is that we are natural investors, as you had stated in some of your charts, but that's important. But more so is important is learning about yourselves. And as you said, Sophie, like, what are my goals? What do I want to do in my life? What are my values? How was I raised? Some of the questions that I ask clients is, what does money mean to you? And so, and oftentimes when you're in a relationship, you have two very different views on money and how much you should be saving and all of that. So I would say that focusing on the bigger planning aspect of things, so financial planning, to educate more of yourself on those topics versus following the market every single day, I think is really important, and understanding your risks. So you may not be involved in the day-to-day finances, and that's okay. But what happens if something happened to your partner that was managing all of the money? What would you do? How much insurance do you have? And I loved your point on organization. I thought that was phenomenal. If you can just get yourself organized, so you've got an Excel spreadsheet or a piece of paper that has all of your financial life on it. So there's lots of great books on there, and I have a list actually, but not in front of me, that we can send out to some people about that. So we did have an interesting question come across. Let me grab that. It's from the chat. How is the pandemic how has the pandemic financially affected women specifically?
Yeah, so that's been an interesting one, and one that I've been watching carefully, because on the one hand, I mean, even just speaking to friends of mine, many of whom also have careers, and we used to travel a lot for work. I used to be on an airplane almost every week, and I have not been on an airplane all year, and probably won't be on an airplane again before next summer for professional purposes, at least. And so in some ways, it has made, I think it has equalized, the pandemic has sort of equalized life across the genders from a career or sort of from a professional standpoint, because now everybody is at home and everybody is pitching in. There's not this pressure of FaceTime or, you know, that kind of thing. At the same time, there is also a lot of research showing that women are still, even during the pandemic, or especially during the pandemic, having to pick up more of the responsibility, it seems, than men typically are right now. So if we think about, if we have school-age children, many times women are the ones that are administering all of the schooling and keeping on top of that, and women are still doing more of the housework, and, you know, women are still all of those sorts of things. And so there, I think, you know, it has affected women in the sense that, you know, anxiety levels have risen and additional workload and burden has increased. And so there it's sort of, there's research that's suggesting, it's too early to really be able to conclude, I think, but that's suggesting that the pandemic is actually setting women back professionally and sort of financially at the moment relative to the gains that had been made. I think that it's a little bit too early to really be able to tell. I think it depends on the age of the women. I think it depends on if you, you know, are professionally active at the moment and in what sector. Do you have the option to stay home? Do you know, sort of what is the other situation? Again, it's very circumstantial, and I think it's still too early. I think a lot of people are still making decisions about their life and how they want to organize it. I know a lot of families are sort of shifting and realizing, all right, this is here longer to stay than we initially thought, and so we're pivoting. So I think it's a little bit too early to say, but it's definitely a point of interest for a lot of researchers. Meg, what have you seen just among your clients in your community?
Yeah, I do agree. I do think that there is some more anxiety, especially if they have younger children, you know, I think this is just a natural, women tend to feel it's more on them, but I mean, it's obviously very family specific, but yeah, I do see the anxiety with it. I would say though that this might be an opportunity for younger women in the future, because as many of us are working from home, and as women begin to have children or they have young kids, they might realize that, hey, I can still work from home and have children, and employers are going to be more apt to, you know, hire people, as you've been hearing, no matter where they live. And so I think there'll be more opportunities for women to remain in the workplace, potentially, you know, after post-pandemic. So, but yeah, it is an interesting topic that I think we're watching closely. I have a couple more questions. I want to make sure we get to those. One is, can you give any advice on how to evaluate the performance of a financial advisor? For example,
that's a good one.
What kind of benchmarks?
Yeah, that's a really good one. I mean, I think, you know, looking at, you know, credentials can be helpful in understanding, you know, how have they been trained? What sort of certifications do they have? But more than that, I mean, so you want to make sure that they have the right credentials and that they are certified. More than that, though, I would talk to other people among your community and in your group of friends of who do they work with, and what is it that their advisor does for them, and see, does that resonate? Does that actually apply to you as well? Especially if you have any unusual circumstances, knowing that you have somebody that you can rely on that is an expert in what it is that you need expertise in is really helpful. And then meet advisors. In some ways, even speaking to advisors, oftentimes advisors say, you know, I have all these certifications, I have all these degrees in economics and finance and business and that sort of thing, but really, I wish somebody had told me that I should have gotten a degree in psychology, because so much of my time I'm actually sort of coaching and working on sort of emotional topics with clients. And so I think that by the same token, as a client, I think it's really helpful to meet with a few different financial advisors to kind of get a feel for, do I feel comfortable with this person? Do I trust them? Because ultimately, you're going to be sharing a lot of personal information with them that is, sort of dollars and cents kind of personal information, but also, as we were saying, right, knowing what are my hopes, what are my dreams, what are my fears, what are my anxieties, and making sure that you're working with somebody who you feel has the time and the interest to listen to that, and to really tap in and tune into you and to other family members that might be part of this relationship as well, is really, really important. So I think that yes, there's the bare bones, making sure that they are sort of upstanding citizens, but more than anything, it's almost that emotional connection and feeling in place, and knowing that the person that you're going to be working with is going to have a lot of information about you. You want them to have a lot of information about you, and do they have the expertise to do that, especially if you have any more unusual circumstances. But definitely, I mean, inquiring, the Better Business Bureau has information, or any local community organizations have information about who works in your local community, and then obviously a circle of friends that you trust can be helpful in finding out who do you work with, and what do they do, and does that seem like it resonates for me.
Great advice, Sophie. I'll just add that there is a website, FINRA Broker Check, where you can actually check an advisor's record. If there's any complaints on their record, it will be there. And now advisors are required to have that on their website, so you can access that as well. I just want to address the benchmark part of that question. How do I evaluate versus a benchmark? There is a difference between a financial advisor and a money manager. So depending on what you're looking for a financial advisor, as I always say to our clients, every one of our clients is very unique. We're all saving and investing for something very different. And so your benchmark is going to be different than someone else's. Your risk tolerance is going to be different. So while we certainly talk about the returns in the market and compare portfolios to that, really you want to be comparing to what is the rate of return that you need to get yourself to your goals. So we have one more question. Can you talk about, this is a great one actually, can you talk about the priority of saving for retirement versus college? I've always been told, I've always been told to save for retirement first, but with my oldest daughter's college coming up in less than 2 years, I wonder what the best approach is for saving.
So I think I love to hear Meg's response too. My response to that is you can take a loan, and your daughter would be able to take a loan out for education, but there's no such thing as a loan for retirement at the moment. Not yet, at least. That does not exist. So I would second the advice that you've always heard, and say, make sure that you're saving for your retirement and that you're covered there. Now, that doesn't mean, that you have to not save for college at all. You could still save some for college, but if you had if it was between, you could only save for one, I would say let's save for retirement and make sure that you're covered there, because you will be able to get some form of a loan and apply for different types of loans for college, but that's not an option for retirement. That would be my answer. Meg, what is your perspective on that?
Yeah, I would tend to agree. We say there's no loans for retirement. And so saving for retirement should be your priority. Although I would say that there's no right answer as far as how much you should be saving for college education. So, and we all have different views upon how much we should save for our kids or how much we should pay for our kids' education. And oftentimes it's from our own upbringing. And so what I do is I encourage, if there's a couple, to have that conversation is, what is it that each of your goals, do you expect to fully fund your child's education? Do you expect to fund an in-state school and maybe they work for their spending money? What is it specifically that you're trying to achieve here? And I encourage people to have that conversation early on. And for some couples, they actually discuss it before they have a child. But early on, when your child is young, is discuss what your strategy is going to be. I know I have 2 boys myself that, you know, when kids are young, you've got a lot of expenses. And one of the things we tell our clients is after you've gone through those young years when you've got maybe daycare expenses, you know, at that point in time is really when you want to start really stuffing money away for educational expenses. So, but looking at things like private schools versus public schools, which as most of us know, there's a huge difference. And so really, really, you know, having a discussion about what is it, the goals that you're trying to achieve. And even when the kids are in high school, I even say, you know, talk to your kids about that. And there's some strategies that, you know, because we don't want our kids getting to 18 and then all of a sudden saying they want to go to a private school and we don't have the money for it. So those are difficult conversations. But we've encouraged clients to use 529s from a tax perspective. I think that's one of the best places to save for education. But again, it's very unique to your own situation. So yeah. We're at 1 o'clock, and so I think we've got all the questions answered. I just want to wrap up by saying thank you all for attending today's session. We very much appreciate you being here on behalf of the Madison Public Library. We will be hosting more educational seminars down the road. We do not have the topic yet for the next one, but we encourage you to give us some feedback. So if you have any suggestions for topics that you'd like to hear, please let us know. We will be sending out a survey to you via email. So if you could please answer that question, we'd greatly appreciate it. So with that, again, thank you all for being here. I wish you all good health and have a great day.